If you make your payments on time every single month, why does your bank balance still feel stuck? You're responsible. You're consistent. So why does financial freedom still feel distant? That's not an accident. If your savings barely grow, even though you pay every bill on time, it's usually not a discipline problem, it's a design problem. Because the financial system is not built around what you can truly afford long-term. It's built around what you can keep paying every single month. The system rewards predictable payments. The more consistent your monthly commitment, the more valuable you become, not as an investor, but as a borrower. Let's imagine someone typical. Not rich. Not struggling. Just financially stable on paper and quietly stuck underneath. Meet Daniel. He's 29 years old, works in marketing, and earns what most people would consider a solid middle-class income. He makes $78,000 a year. After taxes, that becomes roughly $4,800 per month deposited into his bank account. On paper, that sounds comfortable. It sounds stable. It sounds like progress. But now, let's quietly look at where that money actually goes every single month. Rent takes nearly $2,000. Before anything else, a large portion. Then comes the car payment. $500 a month for transportation. That's student loans, credit cards, insurance, utilities, each one reasonable on its own but heavy together. By the end of the month, maybe a few $100s remain. Not zero, but not freedom either. Daniel doesn't feel irresponsible. He pays on time, avoids late fees, and believes he's doing exactly what adults are supposed to do. He feels normal. Because almost everyone around him lives with the same monthly commitments and the same quiet pressure. And that's the important part. Normal doesn't mean optimal. It just means common. This isn't just Chicago. The same structure repeats itself across London, Berlin, Toronto, and beyond. Different currencies, different salaries, but the same pattern of fixed monthly obligations. After tax income arrives, and almost immediately, most of it is already spoken for. Housing, co-finance, student loans, credit cards, each one quietly claims a portion of future income. Notice something important: these are payments, not ownership. Access, not freedom. Banks don't measure how much you own. They measure how reliably you pay. The more predictable your payments, the more valuable you become as a long-term revenue stream. Let's take something simple: $32,000 financed over 6 years at a typical interest rate. The monthly payment feels manageable, around $540 per month. But over 72 months, that small payment quietly turns into nearly $40,000 paid back. That's more than $7,000 in interest, simply for the privilege of paying slowly. And during those 6 years, the car itself is losing value every single day. The bank, however, is not losing value. It is gaining predictable income every single month. Predictable income is extremely valuable in finance, more valuable than one-time profits. When you sign that contract, you don't just buy a car, you create a 72-month income stream. The same structure applies to mortgages, just stretched over decades instead of years. A $400,000 mortgage can quietly become $900,000 paid over 30 years. And if you refinance that mortgage, the clock often resets, extending payments even further into the future. From the bank's perspective, this isn't personal, it's structural. Long-term contracts create stable, predictable cash flow. But from your perspective, every fixed payment reduces flexibility, and flexibility is financial power. The more of your income that's pre-committed, the less room you have to adapt when life changes. And life always changes. Job markets shift, health issues appear, economies slow down. This is where psychology enters the picture. Humans don't evaluate total cost, they evaluate monthly pain. $32,000 feels overwhelming. $540 per month feels manageable. $400,000 feels impossible. $2,600 per month feels achievable. Your brain anchors to the smaller monthly number, not the total long-term commitment. And that framing quietly shifts your focus from ownership to affordability. Now let's look at what rarely gets calculated: the opportunity cost of that $540 payment. $6,480 per year could have been invested instead of spent. At a modest 7% annual return, that money begins to compound quietly in the background. After 10 years, that redirected payment could grow to roughly $90,000. After 20 years, that same consistent investment could approach $265,000. Notice something important. The interest you avoided paying is small compared to the compounding you missed. The true cost of easy monthly payments isn't just interest, it's lost future growth. And this effect multiplies across phones, furniture financing, and buy now, pay later purchases. Each one feels small, individually manageable, emotionally justified, but collectively, they quietly limit your ability to invest and build long-term independence. Adil understands something most people miss. It's not about avoiding banks, it's about understanding the system. Because the most profitable customer is the one who pays on time for as long as possible. And awareness is where real financial control begins.